Welcome back to Talk Tickers. If you are tuned in right now, you know the drill. We don't do surface level headlines, we don't do PR spin, and we definitely don't do cheerleading.
We take the earnings calls that actually move the market, strip out the fluff, and find the signal.
And today we are tackling an absolute monster.
This is arguably the most critical earnings call for the entire media sector in years.
We are dissecting the Netflix Q4 2025 earnings call. And before we even get to the numbers, we have to set the scene. Context is everything here.
Absolutely.
So it's late afternoon, January 20th, 2026. The broader market is already in a foul mood. A classic wrist-off day.
Right. Renewed tariff fears swirling around. Tech was already selling off. The whole backdrop was pretty ugly before the print even hit the tape.
Exactly. And then 4 p.m. Eastern, Netflix drops the release. And if you just glance at it, I mean, just the bold text.
It looks great.
It looks like a party. They beat on earnings. They beat revenue. Subscribers are up. But, and this is the whole story today, the stock is trading down in the after hours.
Mm-hmm. And not just down a little. We're seeing a slide of about, 4.8%?
Yeah, from a close of $87 down to around 83.
And that divergence right there, that's the tension. Why does a company deliver a clean beat, just solid numbers, and get punished for it?
It is the $82 billion question, literally.
The market is looking past the fantastic quarter they just had.
And staring directly at this massive elephant-sized acquisition of Warner Bros. That is just hanging over everything.
And specifically, the fact they're turning off the share buyback machine to pay for it. That's a huge change to the whole thesis.
We have to unpack that. That acquisition risk is where the real story is. But first, we have to eat our vegetables.
Right. Respect the numbers.
Let's do it. Give us the clean beat. What did the core business actually do in Q4?
Operationally. I mean, they're just firing on all cylinders. This is a mature company that's still acting like a growth stock.
Okay, so the headline financials.
GAAP diluted EPS came in at 56 cents. Yep, beat the consensus of 55 cents. Just by a penny, but still.
Let me ask you, though, was that a high-quality beat? Or was it, some one-time tax benefit or accounting magic?
No, this looks like real quality operational leverage. But the real muscle flex was the top line. Revenue hit $12.051 billion.
Which is up.
Up 17.6% year over year. And it beat the street's number of around $11.97 billion.
I want to pause on that. Almost 18% top-line growth for a company this big. I mean, usually the law of large numbers kicks in, and you're fighting for basis points at this scale.
Exactly. To accelerate revenue growth at this size requires a massive engine. And they clearly have it. And they're not just growing, they're getting more profitable.
Okay, let's hear it.
Operating income was just under $3 billion, $2.957 billion. And their operating margin hit 24.5%.
Okay, contextualize that margin for us. Where were they a year ago? Because a 200 basis point jump in a year is no joke.
They were at 22.2% in Q4 of 24. So yeah, that is significant margin expansion. It shows pricing power, cost discipline, all of it.
And the subscriber army, what's that look like?
Still growing. They ended the period with over 325 million paid memberships.
Wow.
And crucially, the cash generation is there. Free cash flow for the quarter was $1.87 billion, bringing the full year 2025 FCF to $9.5 billion.
Okay, so let me play bull for a second. Revenue is up almost 18%. Margins are expanding. They generated almost $10 billion in free cash flow. If you showed me this spreadsheet without the company name...
You'd say the stock should be popping, 5, 10%?
At least.
In a vacuum, absolutely. But markets don't trade in a vacuum. They trade on the future. And Netflix's future just got incredibly complicated. The market is pricing in integration risk.
Let's talk about the elephant, the Warner Bros. Deal.
An all-cash bid, roughly $82.7 billion. That's $27 to $5.75 a share for Warner.
All cash. That is a staggering check to write. That basically wipes out the war chest.
It does. And this is the immediate pain point for investors. To preserve cash for the deal, Netflix has explicitly paused share buybacks.
And for the last couple of years, that was the whole story. Capital return. They generate cash, they buy back stock, your EPS goes up. That machine just got switched off.
Right. They're telling shareholders, we aren't giving you the cash back right now. We're going to go buy Harry Potter and Batman instead.
And there's an immediate P&L hit too, right?
Yes. They're absorbing about $275 million in acquisition-related expenses already. That's compressing the near-term margin optics. So even though the core business is healthier, the headline numbers are going to look messy.
Management had to know this would go over like a lead balloon. How does Sarandos and Peters frame this on the call?
Very, very carefully. They're trying to reframe the narrative away from empire building which Wall Street
Because
hates.
it usually destroys value.
Exactly. They're framing it as strategic acceleration.
Strategic accelerant. I love the corporate jargon. What does that actually mean?
It means vertical integration. They're arguing that owning the IP and the studio reduces their long-term content costs. CFO Spence Newman made a crucial point, trying to calm everyone down. He noted that even after the deal closes, 85% of the combined company's revenue will still come from the core streaming business.
So the message is, don't panic, we aren't becoming a dinosaur studio. We're still Netflix, just with a bigger library.
Precisely. But they are buying a legacy studio. And this led to, I think, the most fascinating moment of the entire call. Ted Sarandos completely flip-flopping on movie theaters.
Oh, I caught this. This is a total 180, isn't it? For a decade, Netflix was the anti-theater company. They fought the windowing game tooth and nail.
It was a significant evolution of thought, let's say. Now that they're buying Warner Bros., suddenly the tune has changed. Sarandos dropped a line that will be quoted for years.
What was it?
This is a business and not a religion.
That is a great line, but it's also incredibly convenient. It basically admits their old religion of streaming only was just a tactic.
It's pure pragmatism. He admitted they missed the boat on building a theatrical distribution network themselves. They were too focused on streaming.
So instead of building it, they're buying a turnkey solution.
Exactly. They're keeping the whole Warner theatrical engine. And this is the key. They're keeping the 45-day exclusive theatrical window.
That is wild. Netflix, the company that terrified the Cineplex, is now going to enforce a window where you can't stream the movie at home.
They finally realized the math works. The box office is a giant marketing funnel. A movie makes $500 million in theaters, it creates a cultural moment, and it performs better on streaming later.
So they get to monetize you twice, once at the ticket booth and again with your subscription.
But there is a massive hurdle here. The regulators, the DOJ, the European Commission, this is a huge consolidation. Is the market pricing in the risk that this deal gets blocked?
It has to be. You don't trade down 5% on a beat unless you think you're walking into a trap.
That regulatory uncertainty is a huge part of this. But, management sounded surprisingly confident on the call.
How do you possibly argue that putting Netflix and HBO under one roof isn't a monopoly?
By redefining the market. Sarandos laid out their whole antitrust defense. He argued that the definition of TV itself has fundamentally changed.
We're just a small fish in a big pond defense.
Exactly. He explicitly cited YouTube, Amazon buying MGM, and social media. His argument is, we aren't just competing with Disney+, we're competing with Fortnite, with TikTok, with taking an app.
If you define the market as total human attention, then yeah, maybe you have a case.
It's a clever legal argument. Whether the DOJ buys it is another question entirely.
Okay, let's shift gears. We can't ignore the engine that's paying for all this, the ad tier. It feels like this is finally moving from science project to real driver.
Oh, this is the unqualified bright spot of the report. The ad strategy is absolutely working.
Give me the numbers. Is it material yet?
It's getting there fast. In 2025, ad revenue topped $1.5 billion.
Yeah.
For 2026, they're forecasting it to roughly double again.
To $3 billion.
To around $3 billion, yes.
Doubling revenue on a $1.5 billion base, that's startup growth inside a mega cap company.
It is. But they were transparent about the challenges. They admitted there's still a gap in ARM that's average revenue per membership.
Okay.
Wait, explain that. An ad tier sub generates less total revenue than a standard plan sub. How is that possible? You'd think ads plus the sub fee would equal more.
It's an inventory problem. They have more people signing up for the ad tier than they have sophisticated ads to show them. Their fill rates aren't perfect yet.
So they have the audience, they just need to get better at selling the ad slots.
No, seriously. They're building out their own ad tech stack to fix it. Once they close that ARM gap, the ad tier becomes a massive profit machine.
But to keep any of these customers, you need hits. What does the 2026 content slate look like?
They're promising a smoother cadence this year. They dropped some heavy hitters. Bridgerton Season 4, One Piece Season 2, The Night Agent Season 3,
Those are the anchors.
and the new Greta Gerwig Narnia film. That's their big swing at a new massive IP,
Oh, I forgot about Narnia. That's their attempt at a Harry Potter-sized cultural event.
which, fits perfectly with the Warner deal. And they're getting into this video podcast thing. Deals with Spotify, The Ringer, Barstool.
Right, the modern talk show format. It feels like they want to be the default operating system for your television.
For everything. Which brings us to the innovation side. Did you catch the bit about gaming?
I did, and we have to talk about the Buggle anecdote.
Ah.
That was unexpected.
It was a rare moment of levity, but I think it was scripted to prove a point.
So Spencer Wang, the VP of Finance, claims he's the internal champion for the new Boggle game on TV, and he called out the co-CEO Greg Peters.
Said his family is crushing Greg Peters' family at Boggle.
I love that. But seriously, why are they talking about Boggle on an earnings call with billions on the line?
It's not about Boggle. It proves the tech works. They're pushing a cloud-first gaming strategy that expands right to your TV. They're coming for the casual party game market.
The Jackbox Games model. Use your phone as a controller.
Exactly. No console needed. And they announced a FIFA football game is coming.
Now that's a huge IP. If
Yeah.
they can get people playing FIFA on their TV without a PlayStation, that's a genuine disruption.
And it feels like they're trying to shift the goalposts on metrics. They used to just hammer view hours. Now they're talking about value delivered and fandom.
Explain that. Why move away from hours?
Because hours can be misleading. They use Japan as an example. People there watch less TV overall. So by hours, it looks like a weak market. But by retention and fandom, it's incredibly strong.
So they're trying to get Wall Street to look at the quality of engagement, not just the quantity.
Which is smart, but much harder to plug into an Excel model. Wall Street hates metrics it can't easily quantify.
Speaking of spreadsheets, let's talk guidance. This was the other shoe that dropped, right? The outlook was a bit soft.
Correct. For Q1 2026, they guided for revenue of $12.157 billion and EPS of 76 cents.
Which the street saw as.
Light. The whisper numbers were higher.
And for the full year.
Revenue between $50.7 and $51.7 billion, so 12 to 14% growth, and an operating margin target of 31.5%.
31.5% sounds great, but didn't they imply it could be higher?
Yes. They explicitly said that target includes a 50 basis point drag from merger costs. Without the Warner deal, margins would be expanding closer to 32%.
So we keep coming back to the same trade-off. You get the assets, but you take a hit on the margins today.
And that is the Wall Street dilemma. The narrative has completely shifted. It's gone from platform compounding to integration risk.
And investors hate integration risk. It's messy. Synergies don't materialize.
Exactly. You have to choose between the clean, beautiful fundamentals of the core business and this messy, capital-intensive future of digesting a legacy studio.
And the options market was expecting fireworks.
It had priced in an 8.2% move, which just shows you how much uncertainty was baked in.
So what does it all mean?
It means Netflix is no longer just a streaming play. It's becoming a full-blown media conglomerate, and the market needs time to figure out how to value that.
Okay, that brings us to my favorite part of the deep dive.
Time for the not financial advice segment.
Let's get the disclaimer out of the way. We are just two voices on a deep dive. This is for informational purposes only. Do not trade based on this. We are not financial advisors.
So what's the pitch today?
I'm calling this one the Sarando straddle, or maybe the Boggle hedge.
The Boggle hedge.
I'm listening.
Okay, here's the trade idea. It's a pair trade.
Walk me through it.
Leg one. You go long Netflix. Why? Because they just admitted the theatrical window works. By buying Warner, they now control the supply of blockbusters. Harry Potter, DC. They own the IP.
Right.
So they can squeeze the theater chains on terms. The theaters need Batman to survive. Netflix can use that box office revenue to subsidize their streaming churn. It's a perfect flywheel.
Okay, so you're betting on them leveraging a content monopoly. What's the short?
You short the popcorn pure plays, the traditional theater chains, they're going to get all their margins squeezed out. They just become landlords for Netflix's IP.
Oh, brutal. But I see the logic. So where does Boggle come in?
Here's the hedge.
Yeah.
You buy deep, out-of-the-money calls on interactive gaming ETFs.
Sure. Because we're betting Spencer Wang's Boggle obsession isn't just a joke, it's a signal, a Trojan horse. Netflix is trying to turn every TV into a console, if they succeed with FIFA.
The console market in 2027 gets destroyed.
So you're betting that Boggle is the canary in the coal mine for the death of the PlayStation.
I'm betting if Spencer Wang can beat Greg Peters at Boggle, Netflix might just be able to beat Sony at gaming.
That is a wonderfully outrageous thesis. And again, definitely not financial advice. Absolutely not. But stranger things have happened. Pun intended.
Pun acknowledged.
All right, let's wrap this, recap it for us.
Netflix beats the quarter. Ads are on fire, revenue and margins are up. But they scared the market with a massive $82.7 billion acquisition of Warner and by turning off the buybacks.
The company is betting the farm that content is king. Meanwhile, the market, for today at least, is screaming that cash is king.
And until that deal closes and the integration proves itself, that tension is going to define the stock.
So here's our final thought for you. Do you think this Warner deal actually gets approved? Is the DOJ really going to let Netflix own Batman and Harry Potter? Or is this a massive regulatory trap that kills the stock's momentum for the next 2 years?
Let us know what you think.
That's our deep dive on Talk Tickers. We'll see you at the next print.
Thanks for listening.